Good morning and welcome to today's webcast, a 2016 year-end federal tax update. Before we begin the presentation, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning. Welcome to our 2016 Federal Tax Update. This is the first of a three-part series addressing tax issues for technology, life sciences, and communication companies. Today we'll be talking about federal tax issues. Next week we'll talk about international issues, and the week after that we'll talk about state and local tax issues. My name is Rich Croghan. I'm a tax partner with Moss Adams here in San Francisco. I'm the tax leader for our National Technology Group, and I will be today's moderator. To start off, I'd like to introduce our presenters. I'll start off with Shannah Gardner. She's a tax partner down in our Orange County office. She specializes in compliance, provision, and consulting services to technology companies. John Murphy is a tax partner in our Silicon Valley office, and he also provides compliance, provision, and consulting services to our technology companies. Dawn Ray is in LA, and she's a director in our national tax practice. She specializes in tax controversy and mergers and acquisitions. She has an attorney background, and she's the type of person you want in your corner if there's any issues. Tom Sanger is a tax partner in our Seattle office. He heads our research tax credit group and has been in that area for nearly 20 years. So today we want to talk about, give everyone an overview of some things that we thought you should be aware of. Shannon will start off talking about some new filing dates. So the IRS this year is mixing things up and changing some long-held tax return due dates. So we want to make sure everyone's aware of that. Also, with the outcome of the election, there's a lot of discussion about tax overhaul, and we'll review some of the competing plans out there to give everyone a sense of what might happen. Obviously, nobody knows for sure what will happen. And then Shannon will wrap up talking about some year-end tax considerations that companies may be considering. Next up on the schedule would be John Murphy. He'll talk about tax accounting updates and some GAAP changes that may impact how you report taxes on your financial statements. Then we'll have Dawn step in and give us an update on IRS. What is the IRS up to? What's changing? What's new? What to be aware of? And last but not least, Tom Sanger will give us an R&D update. There's a couple new developments that really expand the benefits of the R&D credit, and he'll give us an overview of those considerations. So with that, I'm going to turn it over to Shannon to start us off.
Thanks, Rich. So as Rich mentioned, there's been a lot of changes with respect to tax return due dates, and some of those changes that are particularly of interest to technology-related companies would be changes to partnership extension filing requirements. Previously, extensions were due on April 15th for our partnership companies. Now those will be due March 15th. And so since this is a deadline that's accelerated from what we've been used to for a number of years, we want to pay particular attention if your business is operating in a partnership form. On the flip side of that, C corporations do have a little bit of reprieve in that extension applications will be due April 15th for corporate taxpayers. However, both partnerships and corporations will maintain an extended due date of September 15th, at least through 2026, when that C Corps will get an extra month at that point. But for now, really keep in mind that March 15th deadline for partnerships and a September 15th extended due date for partnerships and corporations. The other change that you would want to keep in mind is the foreign bank account reports. Historically, those have been due June 30th. For 2017, those reports will be due April 15th, although there is a provision for an extension through October 15th. But since that April 15th deadline does fall before our historic June 30th deadline, that is something you want to keep in mind to make sure we don't miss that filing requirement. Some additional changes: if you've got a fiscal year C Corp taxpayer, your extension will be due the 15th day of the fourth month after your year end, and that extended due date will be the 15th day of the 10th month after year end. The exception to that would be for a calendar year corporation or a June 30th year end. A June 30th year end still will need to file their extension application on September 15th, which is similar to what it was before. However, there is an extended due date of April 15th, at least through 2026. After that time period, we get a little bit more time in that we get that additional month for an extension. And the individual due dates for all of us personally, those remain the same, so you'll need to still file your return or extension by April 15th with an extended due date of October 15th.
All right, Shannon. So as we indicated, so that everyone gets CEP credit, everyone needs to complete the 4 polling questions. And so we start off kind of with an easy one, just to kind of get a range of what people, types of companies that are on. So what kind of tax returns does your entity file? Are you a regular corporate filer? Are you a partnership? Are you a small corporation, an S Corp? Do you not file? Let's hope that's not the case, without good reason. Other, some sort of other filing, or I don't know, you're just a finance person and someone else takes care of it. So we'll give everyone 10, 20 seconds to respond to make sure that everyone gets the appropriate credit. And while people are responding, Shannon, one question came in while you were talking. You were talking about the federal due dates. Do you know if there's changes to the state due dates?
Most of the states at this point have conformed to the federal due dates, but there are some states that still remain with the former due dates, and so that is something that you want to keep in mind as you're going through compliance season, to make sure that you're aware of where the particular states that you file in, where they lie with respect to their due dates. So generally yes, however, something to be cautious of, because there are some states that still have not conformed.
All right, and someone else asked that for what returns these are due. So these, can you repeat that?
For the
For what year?
2016 tax year is when these new due dates will kick in.
Okay, that's fantastic. So we're going to wrap up the polling question. Remember, everyone, to hit the submit button. It's down in the lower right-hand corner. It's a black box. Hit submit to make sure that your answer gets recorded. And with that, I'm going to move forward and close it. And it's as kind of I expected. Yeah, 2/3 of the group files a corporate return. There's still 6% that are none. I don't know if what's going on there. Maybe they're independents are just. I hope that they're covered. With that, I'm going to turn it back to Shannon to talk about some potential tax changes.
Well, most of you are probably aware there's a lot of speculation as to what's going to take place with respect to tax reform as President-elect Donald Trump steps into office. The discussion of tax reform is clearly a hot topic. Not only are we having discussions about Trump's proposals, but also quite a bit of discussion regarding the blueprint that was released in June by the House Ways and Means Committee, which will likely be used as a starting point for discussions on tax reform. The blueprint doesn't exactly line up in all respects to what President-elect Trump has proposed, but there are several similarities. I thought we'd highlight some of the main points of each proposal. As you'll see, the overarching theme for both is really an overall reduction in tax as well as simplification of the reporting process in general. Keep in mind as we go through, and as Rich mentioned, at this point, all these items are speculative, and there's no guarantee that this is where we'll end up, but time will certainly tell. On the business front, currently, we've got a top corporate tax rate of 35%, which you're all well aware since most of you are operating in that corporate form. The proposals are to reduce the rate to somewhere between 15 and 20%, which will leave some additional cash in the hands of our businesses to reinvest back into our business and the economy. For pass-through entities, which currently flow through to individuals and can be taxed at the highest individual rate of 39.6%, the proposals are to reduce the rate on flow-through income to 15 to 25%. There's some speculation as to what will be done to add in some anti-abuse provisions for this change to try and create some mechanism where current W-2 owners are prohibited from putting their services into a partnership to take advantage of the lower rate and not paying the higher individual proposed rate. However, the details on this have yet to be vetted out. Currently, both plans propose to repeal alternative minimum tax and to remove some of the more complicated tax-related business provisions that can be pretty cumbersome for taxpayers to maintain. For example, many of you may qualify for a manufacturing exclusion under 199. That would be something that would be up for speculation in terms of whether or not that would continue to be available. But having said that, both proposals currently maintain that a credit for research and development expenditures would remain intact. As far as foreign earnings, as our tax regime stands now, there's a significant amount of cash that remains offshore in foreign jurisdictions. To bring this cash back in the U.S. currently, there'd be a tax burden at approximately 35%. There would be a foreign tax credit allowed against that income coming back. However, both proposals allow for a one-time repatriation of cash to incentivize companies to bring these funds back to the U.S. Under President-elect Trump's proposal, this repatriation would be taxed at a rate of 10%. Under the House plan, this cash would come back at 8.75% tax rate, 3.5% for non-cash assets, and under the proposed plan by the House Ways and Means Committee, that would be payable over 8 years. This is particularly interesting for companies that do have foreign operations, as it'll allow an opportunity to really look at the global structuring and really make sure that the current flow of income as it's designed now is appropriate under the new rules, however those do end up. The other item to consider is NOL carryforwards. currently, NOLs will go back 2 years and forward 20 years. And there's some consideration under the House proposal to eliminate the carryback altogether and just allow for a carry forward, but there would be potentially a limitation at 90% of taxable income. So you would potentially still have to pay tax on that additional 10% of earnings. If we take a look at some of the proposals that would impact us individually, the current graduated tax rate system has several tiers with a top tax rate of 39.6%. Both proposals are to simplify the structure into 3 brackets with a top rate of 33%. Capital gain rates currently include 3.8% for net investment income for high income taxpayers, and both plans propose to remove this additional tax. And the House proposal goes a little bit further and says that we'd reduce capital gains by 50%, but then tax them at the ordinary rates and not keep the different rate structure with respect to long-term capital gains, which currently is 20%. Similar to the business provisions, both proposals include a repeal of the AMT tax regime for individuals. Both proposals also suggest a limit on itemized deductions, proposing either caps on itemized deductions or limitations on the types of items that can be taken as itemized deductions, really focusing things such as mortgage interest or charitable contributions. And then, of course, with respect to estate taxes, both proposals would repeal the estate tax as it currently sits. However, under President-elect Trump's proposal, capital gain tax would still apply to capital gains to the extent they exceed $10 million. What we've highlighted here are really only portions of the 2 tax proposals that we really think would be relevant. The main point to recognize is that there really are some changes coming, and some of them quite significant. So as you're preparing your forecasting and doing your planning, it's important to note that the tax world that you see today might be very different than where you're going to end up in 2017.
All right, thanks, Shannon. That turns us to our second polling question. As a reminder, I sound like a broken record, but you need to complete all 4 of these to get your CPE. So you can click on the dot and then hit the submit button. Don't forget that point. That's really important. But while people answer that, Shannon, a few questions come in. First question was, do we know that these changes, do we know when they're likely to be effective?
Yeah, at this point, and there's some speculation as to how quickly the changes are going to be able to be pushed through. But there is some speculation that it may be retroactive. So at this point, it's hard to tell, and certainly it's top of mind. But as with anything, an overhaul this large might take some time to get through.
Okay. All right, and we're getting a lot of questions in. If we don't answer your question live, we will follow up separately with you. But thanks for the questions. Keep them coming. And with that, we're going to kind of move on. So we're going to get the polling results so we can get through the rest of the information. So it looks like people are generally following it. There's a number of skeptics, which I might be in one of those. That bucket too is I'll believe it when I see it. But this does feel different. It seems like they will do something, but we just don't know what. There's going to be some challenges, and even the Speaker Ryan and the new Treasury Secretary seem to be saying different things as lately as yesterday. So we'll be watching it and we'll communicate as appropriate. So next up on the agenda is some year-end tax considerations. So Shannon, back to you.
Sure. With all the speculation about reducing tax rates in the future, anything we can do to accelerate deductions and reduce income that otherwise would be taxed at higher rates seems prudent based on the information we have at this point in time. To the extent we've got capital expenditures that your company may be considering, for either December or January. To the extent you're able to place those items into service in December and qualify for what's referred to as a 179 deduction, which would allow you to expense up to $500,000 of capital improvement additions, that would be beneficial for you. That $500,000 deduction limit has been extended indefinitely. However, it does begin to phase out once you've placed in service over $2 million of assets. So something to keep in mind. If you do end up in a situation where you've phased out of your 179 or you've got additional fixed assets placed in service, bonus depreciation has also been extended where you can qualify to deduct 50% of the cost of qualified assets that are placed in service through 2016 and through 2017. That bonus depreciation does begin to phase out at 40% in 2018 and 30% in 2019. There are also some ability to claim AMT credits and turn those into refundable credits to the extent you forego bonus depreciation. So if you are a company that's got a significant amount of capital improvements that have gone in place in 2016 and you do have a significant AMT credit carry forward, this is something to keep in mind as you're doing your planning for 2016. Another item to keep in mind, if you've sold stock in a qualified small business in 2016 or are anticipating a sale going forward, that if you have qualified small business stock, which is originally issued stock held for at least 5 years of an active business or in a business with less than $50 million in assets, there are some other specifics that you can refer to in the code, but if you do have something that may qualify for this and the stock was issued after September of 2010, you may be able to exclude 100% of the gain from the qualified small business stock. That gain exclusion would be limited to the greater of $10 million or 10 times your stock basis. And that exclusion scales down depending upon when your stock was issued, and we've left some dates for you there for your reference.
All right, thanks, Shannon. So on to polling question number 3. Based on the prospects of tax changes, are you more or less likely to do year-end tax planning? More, less, or neither? A lot of technology companies may be in a loss situation, so they may not necessarily see the need. It'll be interesting what people's thoughts are here. Once again, broken record. Make sure you hit the submit button. We want everyone to get their CPE credit. We'll give everyone. This is a pretty quick, easy question. We'll just give everyone a few more seconds. One question did come up, Shannon, and it was related to the 179 deduction. Is the $2 million limitation on the 179 an accumulated limitation? I.e., do you have to, is that over a period of years or just all in 1 year?
All in 1 year.
Okay, fantastic. All right, so I'm going to close it up here. All right, it looks like a lot of companies aren't going to do anything regardless of the prospects of tax changes. And like I said, that may make sense for a number of earlier stage companies that may be in a loss situation. All right, thank you, Shannon. All right, now I'm going to turn it over to John Murphy, who's going to give us an update on some tax accounting changes.
Thanks, Rich. So we're going to talk quickly about some tax accounting updates. These are changes that affect the preparation of your tax provision or can affect what your financial statements are going to look like. The first group of changes are part of the ongoing FASB simplification framework. And then I want to touch on a couple of changes in accounting that aren't strictly tax accounting, but have an impact on tax accounting. So the first of the simplifications is the classification of deferred taxes. So presently, deferred tax assets and liabilities are classified on a balance sheet as current or non-current, depending upon the underlying asset or liability that they relate to. And this can be a little tricky, particularly with our tech companies when you've got a valuation allowance. Under the new rules, all deferred tax items are going to be shown as non-current. So it's a nice simplification. The effective dates are, and for public companies, are annual periods beginning after December 15th, 2016. So effectively 2017, these rules would go in effect. And for other companies, a year later, so effectively in 2018. However, early adoption is permitted, and we're finding that a number of our clients are early adopting this one because it's a nice simplification. The second simplification deals with share-based payments, so generally stock options and the way that this is treated. So for book purposes, as you know, the options are, the value of the options is determined up front at the grant date and then amortized into expense for book purposes over the vesting period. Tax is completely different. Options, non-qualified options, are not deductible until they're exercised, and then it's the spread between the fair market value at that date and the strike price. So not only do you have a completely different answer between book and tax in terms of timing, but also in the value, the amount of the expense. So under the current rules, you've got to go through this complex set of calculations, potentially setting up what's called an APIC pool to charge the excess tax benefit, if it's more than book, to equity, and then reversing that out when you have tax deficiencies, when your tax deduction is less than book. So under the new rules, we don't have to do that. The impact of the excess tax benefits and deficiencies will be recognized immediately through the income statement. Also, there was a difference in the old rules. Depending upon whether you were getting an immediate cash tax benefit for your stock option deductions, and now that part has gone away, so it'll be consistent on whether or not you get an immediate tax benefit or if those deductions are just increasing your NOL. The effective dates on here are generally calendar 2017 for public companies, 2018 for other companies, and early adoption is permitted here as well. The third simplification that we want to talk about deals with intra-entity transfers of assets. So this is when you have a transfer or a sale of an asset between related parties. The rule has been that even though that might be a taxable event, you don't show the tax consequences for book purposes until that asset leaves your group. But while that rule will still apply for inventory, it will no longer apply for other assets. So you'll be recognizing through your income statement or balance sheet the tax impact of a sale, even though it's an intercompany sale. For tech companies where we see a lot of IP transfers offshore, which is a taxable event, we'll see that the tax consequences now being reflected in the financial statements. The effective date for this is generally public companies for starting in 2018 and for other companies starting in 2019, and early adoption is permitted here as well. Now I'd like to touch on a couple of non-tax areas that have tax implications. The first is that there are new rules for accounting for leases, and I certainly won't go through those complexities, but suffice it to say that most people believe it's going to cause a lot more leases to be shown on the balance sheet, essentially capitalizing those leases instead of treating them as currently expensed operating leases. Now, there's no change in the tax law in this area. However, you're going to have to review your leases for book purposes, and so it's a good opportunity to look at those leases from a tax viewpoint and see whether you've been properly classifying them as operating leases or capitalized leases. If you find that maybe you hadn't quite been doing it right and need to make a change, keep in mind that that would be an accounting method change that's likely going to require you to request a change in accounting method from the IRS. Also, these new leasing rules could impact your state tax returns if you're apportioning income and your property factor is based on the book calculation of property. So watch out for that as well. And the effective dates here are for public companies, generally 2019, and for other companies in 2020. And early adoption is permitted here as well. And this is going to take a little bit of work, so even though you may not be putting these rules into effect in your company right away, it's a good time to get started on doing the calculations. And then finally is revenue recognition. The new standards are also very complex, and they're going to affect both the timing and the measurement of when you're recognizing revenue for book purposes. And this has more of a direct effect on tax because there are actually several provisions such as contracts with advance payments where the tax law allows you to follow book. And so now we're going to have new book rules. So that means that as you go through your book calculations, you're also going to need to look at whether or not the new answer for book purposes is a permissible answer for tax purposes. And if it is, and if you want to comply so that tax still follows book, then you're going to need to file for an accounting method change on that. If you decide that the method that you're using under the new book rules is not permissible for tax, or you just don't want to follow that method for tax and continue to do it the way you've been doing it, then that means you're probably going to need a second set of records to track your revenue recognition just for tax purposes if it's no longer following book. And the effective dates here for public companies are calendar year companies starting in 2018, other companies starting in 2019. However, early adoption is permitted starting next year. So starting with 2017, you'll be able to adopt these. But again, even if you're not adopting these right away, these changes, as you've probably figured out, are quite complex. If you haven't started working on your revenue recognition, this is a good time to start.
All right. Thanks, John.
That's it. Turn it back to you.
Thanks, John. So yeah, just to kind of reinforce what John was saying, especially on revenue recognition, that there is a lot of discussion on the accounting changes. But I just second what John said is don't forget about the potential tax changes and what companies need to do or should be considering when considering the accounting changes. We also got a question in that I thought was an interesting question. It kind of interplays with what Shannon was talking about with the potential tax changes. So I wanted to set that out to John. So John, the question is, what is the effect on deferred taxes on the books if they are computed under the existing rate, but that a rate change occurs and thus reduces the future tax consequences?
Well, I think the first thing to keep in mind is that under GAAP, you don't reflect new tax laws until periods ending after the date of adoption or the date of enactment. So until President Trump actually signs the new tax law legislation, you would not reflect it in your financial statements at all. And that may happen in the first quarter of next year. It may not happen until the third quarter, if at all. So it's only for periods after the date of enactment. Having said that, if we do get a reduction in the corporate tax rate, then that's going to affect your calculation of your effective tax rate for the year. And it also means that you're going to have to revalue all your deferreds. If you've got a big net deferred tax asset that's valued based on a 35% rate, and we wind up with a 15 or 20% rate, that could mean a significant reduction in the size of your deferred tax asset.
All right. Thanks, John. All right. So we're going to move on to the next topic on IRS update. And with that, I'm going to turn it over to Dawn Ray.
Thank you, and good morning. Now to everybody's favorite topic, the IRS. We are going to briefly cover topics that are relevant to this technology industry group, including common issues raised on audit, potential for reform, changes to large business and international exam process, the IRS's payroll exams, Bipartisan Budget Act, and changes to IRS Appeal. Common issues generally raised on exam with respect to technology industry companies include research and development credits and the domestic production activity deduction. In this space, on exam, what we are seeing is that the IRS specialist in these areas, generally an engineer, is coming to the initial meeting and that these issues are being raised right up front in the exam, and they're raising the questions by this specialist during that initial meeting and interview. Additionally, with the number of deals in this space, we're seeing increased scrutiny with respect to transaction costs, deferred revenue, and also international disclosures, such as your Forms 5471 and other informational filings with respect to ownership of foreign entities. As my colleague Shannon mentioned, there's a lot of potential for reform in 2017. So not only reform to the code itself, including rates, but also the potential for restructuring of the IRS and the exam process. What is currently being speculated is a streamlined IRS, which consists of 3 branches: individuals, business, and instead of an exam process, more like a small claims court type of dispute resolution. So as with everything else, stay tuned for legislative developments. Many technology companies, should they receive notification of an IRS exam, will actually be examined by large business and international group, which has significantly changed its examination process. It's actually changing from an entity-focused examination process to an issue-focused exam process. So what that means is the IRS is currently building teams with technical knowledge and expertise in a particular area, an issue. Those issue teams will then be assigned to an exam, and you do have the potential to have multiple issue teams on the same exam. And that is going forward, again, starting in early 2017, the change from an entity-focused exam process to an issue-focused exam process. So the IRS has said that they will come out and introduce what those initial issues are going to be in early 2017, and they're also going to include some rationale as to why they picked these particular issues or campaigns. So again, in this industry space, many of you will be examined should you receive that notification by LB&I. So we want to make you aware of this pretty significant change to the LB&I exam process. What we're also seeing in this space in particular is an increased number of internal referrals to employment tax specialists. So we have IRS payroll specialists coming to the table at the beginning of the exam, just like we have the IRS engineer specialists looking at the R&D credits as well as DPAT. What we're seeing is they're questioning whether or not people are employees and independent contractors. In addition, especially with respect to Silicon Valley clients under exam, we're seeing heavy focus and scrutiny on fringe benefits. In particular, the IRS is evaluating the employee perks, fringe benefits, and all the various things such as maybe there's a skee ball table or a foosball table or a lunch is provided every day for the employees. They're really taking a fine look at these items, and where they're getting their additional information are publicly available spaces such as Glassdoor.com, various published articles on the company, as well as information that may be published by the company's recruiters in effort to retain and attract fantastic talent. So we wanted to highlight this as we've seen this several times in recent exams, and wanted to make sure that everybody's aware of the IRS is kind of stepping out and looking at other places to understand what is going on with respect to fringe benefits for the technology industry. We also want to make you aware of the Bipartisan Budget Act of 2015. And what the Bipartisan Budget Act of 2015 did is it actually significantly changed the way in which partnership examinations are conducted. What it did is it repealed TEFRA, which is the current way IRS conducts partnership exams, and instead it's replaced it with a single streamlined set of audit rules whereby the exam will take place at the partnership level. So TEFRA is going to be repealed by this streamlined audit process for tax years beginning after 12/31/2017. So unfortunately, we're left with TEFRA as of right now. However, partnerships are allowed, as with many topics discussed, to early adopt into this streamlined audit process. And the reason we also want to highlight this is there are significant changes with respect to how the IRS will conduct these partnership exams and whether or not consideration should be given to your current partnership agreements to address the changes inside the Bipartisan Budget Act so that your partnership agreement is up to date and current with respect to these legislative changes. Finally, we wanted to cover the changes to IRS appeals. For those of you that have had experience with IRS Appeals Conference, you probably realize that it is much easier to conduct an IRS appeal face-to-face so that the IRS appeals officer has the ability to judge the veracity and credibility of your testimony, your facts and circumstances, etc. However, recently, IRS has implemented some pretty significant changes with respect to these in-person conference procedures as well as case transfer procedures. Generally, starting October 3rd and after, the appeals will not transfer cases solely upon a taxpayer's request. Additionally, the decision to hold an in-person conference now has to be made at the request of the taxpayer or suggestion of the hearing officer with the concurrence by an appeals team member. In deciding whether or not to grant a now in-person conference, specific facts and circumstances will be reviewed and considered by the IRS, including whether or not your books and records to support your case are pretty substantial such that you can't easily reference them over a teleconference, and whether or not your taxpayer testimony is so critical to your argument that you really need to have that in-person meeting with appeals. So again, this is just to highlight some of the most important areas that we see with respect to the technology industry and the changes to the IRS.
Thanks, Don. All right, now that leads us to our fourth and final polling question of the day. So make sure that you answer this. I think I went too far. Let me go back. Okay. If you were audited by the IRS, what would your biggest concern be? Would it be related to these employee perks or research credits? We just kind of left it as an either or to kind of get some more input. But Dawn, a few questions came in while you were talking, and I want to address them to you. So when the IRS comes in and they're looking at these fringe benefits, daily meals and such, what are they doing? Are they imputing some income to the employees, and does it matter if the employer already disallowed the expenses on their corporate return?
Certainly. So it's kind of it's an interesting approach. The service wants to first determine whether or not there truly are fringe benefits or if there's something more. For example, if you happen to have a sushi bar that serves incredibly great food, etc., the question has come up, is that really necessary? Is this something that's a lot greater than a fringe benefit? So first and foremost, taxpayers should be prepared to defend, no, this is not very extravagant. This is just something for our benefit to have the employees here over lunch so that, again, in the technology industry, collaboration is key so that they can collaborate with their peers and colleagues and that this is truly just fringe. So first and foremost, you have to make sure what you're doing is not deemed to be extravagant. It's not going to get you on the front page of the New York Times. To the extent that the service does deem something pretty extravagant, they are asking whether or not that amount is being included in the W-2 of the particular employees.
Okay.
And to the extent, our companies, taking this as a 50% meals and entertainment deduction, the service is kind of discredited for the few of these that we have recently seen. That argument that we're not deducting this anyhow, so why should we not? So therefore, we should not have to include this in our employees' W-2s.
Okay. Interesting. All right, thank you. Another question that came up that I think you can address pretty quickly, I hope. So you're talking about the issue-focused exams.
Yes.
Does that in any way suggest that a company could face more frequent but possibly more narrowly focused exams?
That's definitely a possibility. The service has not come out with a full narrative of how they're going to run these campaign or issue-based exams, but they have said it is possible for a company to face multiple issues at the same time. Again, the service has said that they're targeting these campaigns based on areas they believe that there's significant non-compliance risk. So it's absolutely possible, but unfortunately we just don't have the details yet.
Okay, appreciate that. All right, now going back to the polling question, remember everybody hit the submit button. Make sure everyone gets their polling question answered so everyone gets their CPE. All right, and it looks like it's roughly split, and I can certainly understand that. With that, we're going to move on to our next and final topic of the day, our research and development tax credit update. So Tom, I'm going to turn that over to you.
Well, thanks, Rich. I think to start off, maybe a little bit of an overview of the R&D credit. There has been a number of things that have updated. Both there's been a lot of court cases, and obviously the PATH Act has added a couple great areas for startup type companies and smaller companies. But to start off, the R&D credit's been around since 1981. It's been heavily used by tech and life science type companies over these years. Some of the big issues that we've seen through the process is what is R&D and how do you define it? And a lot of that has been figured out through the court cases, some regulations, etc. The regulations tend to not be on point for all companies just because they tend to not be very specific, as well as since it's been around since 1981, what was computer science is completely different from 1981 to today, and so how it's all defined has not caught up, and so the court cases definitely are utilized to kind of figure out what types of things should be claimed, what things should we watch out for. To kind of go over the big picture again is it is defined under 41-174, but really it comes down to what is your company developing new or improved products or processes? And it really is key that it could be both the process as well as the product. In some cases, we have clients that are doing the same product they've been doing for a number of years, but they've been really investing in the new components and the new processes. So really look into both of those areas as we're doing it. As we probably many of you have heard, there's a 4-part test. It's kind of been defined in the code and the regs, but really the court cases have also taken care of this. And as we're going through it, there's 2 big areas that really are the ones that we're focusing on is the technical uncertainty and the process of experimentation. And the technical uncertainty is at the beginning of the development of the new product or process. If you're uncertain about the appropriate design, capability, or methodology, then you can meet this. And you can be, your competitor can already be doing something, so you don't need to be expanding the knowledge in your industry. Just that you as your company needs to be doing something that they have not been doing. And so this is one where some people are thinking, well, I'm not really doing R&D, I'm just doing what we normally do. Definitely an area that you probably are qualifying. Second area is the process of experimentation test, which says that you're going through and you're doing some experiments to prove out and resolve that uncertainty. And that could be through computer modeling, engineering, prototyping, etc. And in a lot of cases, the R&D that is occurring can be sold to a customer. And so that's where, many are having difficulties going, well, a customer came to us and asked us to design or develop this. And so we can still claim it, even if you are getting revenue for it, if the contracts are in a manner that kind of shows that you as a taxpayer retain substantial rights and risk in the project. So that's something really big to understand is when we're doing these R&D studies, we're really focusing on the contracts if there are any, and that could be for subcontractors as well as for your customers, or is it all internally developed? Are you self-funding all this? And there's different areas, and looking at the funded research and the risks and rights is very, very key. And as Don mentioned, the engineers, when they're coming out and reviewing the R&D tax credit, in some cases, they are also doing the legal review. And what we found is they have more difficulties on the legal review. They tend to say nothing qualifies. And so if you're being audited and, the field agent is chatting with you about, hey, I'm going to have my engineer on board, just make sure that the engineer is really evaluating the 4-part test, not the risk or not the funded issues. That should be done by the attorneys or the field agent. So with that, once you kind of know what types of activities qualify, then we capture certain expenses. And there's 3 categories of expenses that we're capturing. One is wages, and wages are for people who are directly doing R&D, for people who are directly supporting the R&D process, as well as for people that are supervising the R&D. And so a lot of times the web does definitely spread through the organization. And so, just keep that in mind as we're going through. It could be very, very, a lot of folks. And on the wage side of things, if there's a group of people that are 80% or more qualified, the IRS says they are R&D folks, and we capture them at 100%. Those that are less than that, then we capture at the percent that they are directly supervising, directly doing, or directly supporting the R&D function. And so there tends to be clusters of people that are captured at 100%, and then others that we're capturing at less than 100%. Supplies are basically any supplies that are used in the R&D process, and in some companies it's very significant, others it's very minimal, and so it really depends on that. And the documentation and support is really key to show why those supplies are needed in the process. Contract research is for anybody outside of your organization that you're hiring to help you with the research and development. We capture them at 65% of the cost, and that basically is just the statutory area. And same thing with wages is we capture them with Box 1 W-2 wages, and so just based on the law. So we know what qualifies. We know what expenses qualify. The other big area on examination is the nexus between the qualified activities as well as the qualified expenses. And so some of our clients do not have significant timekeeping and nexus between that. So we really are kind of recreating that and figuring out how do we prove out that these activities that qualify have these dollars attached to it. And the federal credit is generally in the 5 to 10% range. It's all a mathematical area, and the credits can carry back 1 year and forward 20. The other big changes are with the PATH Act that came out in December of last year. There's a couple areas that really made the R&D credit more beneficial to startups and tech and life science type companies. In the past, companies that were starting up had minimal use for the credit immediately. They would obviously carry these credits forward for 20 years, but they didn't have the taxable income or the tax to basically make these credits usable. And as we go forward, we'll see that now there's a payroll tax offset, and that's for qualified small businesses. It's for pretty much the pure startup, and basically it says we can capture up to $250,000 and offset payroll taxes. So if a company has about $4 million in payroll, they're generating about $250,000 in payroll taxes. And so if that's the case, then if they have had gross receipts for 5 years or less of less than have had no gross receipts for 5 years or less, then we can capture that $250,000 for five years, starting when the gross receipt starts. And you have to have, in the current year, less than $5 million in gross receipts. And so as we're going through that, that's becoming a very, very significant area of now we have these credits that are usable now versus being carried forward into the future, which was kind of the past. So then the question is, when does this new payroll tax offset take effect? It's only effective for qualified expenses incurred in 2016. Even if you've been claiming the credit the last few years, those credits will still carry forward just like normal, but you can't offset them for the payroll. The activities that are occurring in 2016 are the only activities, and forward are the only activities that can do it. You do elect them on your 2016 federal income tax return, and you cannot amend to get it. So we need to capture those. If you are in the small startup phase, we need to capture those on the originally filed return, and they can be through extension as well. They are claimed on the quarterly payroll return. So once you've captured on your federal return, then the offsetting benefit up to $250,000 flows through Form 941 and is captured on the quarterly payroll returns. And so the real key is filing your 2000 federal income tax return. You can't claim it on the Form 941 until you've filed your federal income tax return. So if you get your federal income tax return by March 30th, then we can utilize those benefits on the 941 that's filed in July of 2017. We can begin reducing your payments every week or month or quarter once you have filed your tax return. So it is really key, and I think we're going to see a lot more filers who want to take advantage of this rushing or trying to get their return done on the earlier side of things versus waiting till the September deadline. And then there's the AMT offset for eligible small businesses. And AMT offset basically says if you're under $50 million, then the tenement minimum tax is treated as a zero. And so it's going to be a great one for those who have been fighting AMT. And so as we're going through that, the next area just relates to the 5-year carryback and 20-year carry forward. And basically, this only applies to credits that are generated in 2016 forward for this AMT area. With that,
all right, thanks, Tom. There's a few questions that came in that I wanted to address. So earlier on, Dawn mentioned that the IRS frequently audits the research credit, and you kind of gave a nice overview of the credit. What areas do you see generally scrutinized when a company claims a credit?
As I mentioned, the contract review has been a very significant one over the last 24 months. And it does change quite a bit throughout the areas. Some of them relate to highly compensated employees. If you have founders who are scientific or engineers, things of that nature, highly compensated, and they're heavily involved in R&D, the amount of support and documentation that supports their percentage of being, say, at 80% or 100% or very high percentages is big. The contract review, understanding what those contracts are, both for your subcontractors as well as your customers, if you have customers, is very important. The areas they're basically saying that the IRS and the states are saying, well, the rights aren't yours unless it's spelled out in the contracts. And in those cases, we're working with Dawn and her team to go to appeals and basically explain it away. But those are the big areas, and then Nexus is always one as well.
Okay. One question. We only had time for a quick answer, so dodge it if we need to. But the question was whether that contract research from foreign sources are those expenses creditable?
They are not. In some cases, the foreign entity actually has employees in the United States. Those employees, if they're in the United States, would qualify for the federal credit. Same thing with the states as well. The dollars have to be originating from either the state for the state credits or the United States for the federal credits.
Okay. All right. Thanks, Tom. So with that, we're running up at the end of the hour. I'd like to thank everyone for attending. We hope everyone found this useful. We did get a ton of questions. We weren't able to get through them all. We will follow up and respond to those questions that were posed. I'd like to remind everyone that we do have the International Tax Update next week, same time, same place. If you have any questions on anything that was discussed, feel free to reach out to any of us. You see our email addresses there. I believe you can download the presentation if you want to review it. Or you obviously have some connection with Moss Adams. Reach out to the tax provider or tax advisors you generally work with. But again, last but not least, just thank you again. And with that, I'm going to turn it back to Emily.
Great. Thank you, Rich, and thank you to all of our presenters today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive that credit. You can download this from the slide deck and handouts widget at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open this and click the printer in the lower right corner to download a PDF copy now. I'll be keeping the webcast console open for a few minutes to give you time to do this, and if you have any technical difficulties, we will be emailing a copy of your CPE certificate within the next 2 weeks. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us for our presentation next week.